morning. My name is Rachel Allen-Backus, and I'm the publisher of the Sustainability Report. Welcome to this discussion, Taking ESG Integration to the Investment Committee, in which we'll talk how environmental, social, and governance factors are integrated into institutional investment decision-making, and why ESG integration has not been more broadly adopted by Australian fund managers and asset owners. Integrating ESG factors into the investment process has been an industry discussion topic for many years, but it's not universally accepted practice in Australia or around the world yet. ESG integration in the investment process is the guiding principle behind the UN Principles for Responsible Investment, and participation in the PRI is increasingly demanded when asset owners appoint external fund managers. According to the PRI, as of April of this year, assets under management by PRI signatories stand at $23 trillion US, up from $4 trillion when the PRI was founded in 2006. There are 42 asset owner signatories and 85 asset manager signatories in Australasia alone, meaning that ESG integration should be a given here, but that's not always the case. To discuss why the broad adoption of ESG has not gone more quickly or more profoundly, as well as look at how practitioners do integrate ESG into their processes, we have an expert panel.
But it's through experience that you gain knowledge. So how do you gain the knowledge to do something? How do you gain the knowledge to ride a bike? Well, you probably fall off a few times. How do you gain the knowledge to drive a car? Well, hopefully through experience. Hopefully you've got somebody to help you along the way and you don't have accidents. But, similarly, how do you learn to invest? And where do you get the knowledge to invest? And that comes through experience as well. And through that experience, you manage lots of different areas of your investment process, and one of them is managing the risks. And what we've seen over more recent times is that the risks that are required to be assessed when you're investing, the risks have become more broad. The risks that affect the companies in which you make investment decisions have moved from a more traditional focus of analysing the balance sheet, profit and loss and cash flow, to looking more widely at the externalities that company includes in its operations, and that has included in its operations without having to incur a cost. But society's changing. The investment horizon's changing, and investors need to take into account this broader set of risks. These risks have been labelled, I suppose, more recently under the banner of environmental social governance research, and it's through experience and through knowledge that you can account for the risks that these companies face, that you can bring this knowledge into your investment process. I'm not saying that traditional analysts don't investigate these risks. I'm not saying that they're not considered, but that the way that analysts have approached their research, the way they're expected to approach the research, the strains that they have on them, might lead them to focus more on the traditional investment criteria. I mean, I certainly know when I did my Masters in Finance in 2003 that it included a little bit of governance, and governance was starting to become more important, but there was very little, if any, environmental or social issues that were addressed. And so it's the same when I have discussions with analysts. When I'm speaking to analysts, they'll often look at the issues through a very narrow window. If you like, it's almost like through providing the knowledge of the ESG risks, we're trying to take those blinkers off and make the risks more aware to investors. I mean, some of the analysts that I've spoken to look at mining companies might look at the research we have, and we've got reports with key issues, and we spend a lot of time identifying materiality, and they'll look at that report and go, we're only interested in fatalities. Now, that might be okay, but if you want to account for all the risks that are faced by the company from an environmental social governance perspective, you need to dig a little bit deeper than that. And that's what MSCI ESG research provides. We've got teams who've been doing this research for 20 years, who've been looking into these issues and identifying the issues based on multiple areas of concern around the environmental, social governance profile of a company. And we spend a lot of time analysing companies' operations and identifying which of those operations have the most exposure to environmental and social risks. And that's what it is that we're trying to bring to the table. We're trying to use the fact that MSCI is a leader in ESG research ratings. That the ratings were, when MSCI put those ratings out, they were the first of their kind on the marketplace. We're leaders in controversy analysis, in business involvement screening, and we were one of the first to bring the fixed income research, ESG research, to investors. Likewise with portfolio analytics reports that allow asset owners to assess their ESG exposures. And to bring this analysis, to stop having it being isolated by a group of ESG research analysts and having it integrated into the mainstream process. Putting it on platforms like Barra and FactSet, so that it's in the same tools that are being used on a daily basis. And that's where ESG research needs to be. It needs to be considered in an ongoing basis, not as a special part of the investment process.
I'm based in London, but I have the real privilege of talking to asset owners worldwide on this subject, amongst others. I work broadly across strategy, but this is a subject that is obviously going up the agenda. And I just want to relate a few thoughts about the journey that many asset owners are either going on or not going on. And those that are, I'm going to use 3 words for it. I'm going to use the word difficult, interesting, and also rewarding. And I mean rewarding actually both financially and non-financially. But the word that sticks is difficult. And one of the reasons for that is that this is all about sustainability, and that word is very tough on individuals in our industry. And it's really because we have a practice of walking up to portfolios pretty much on the quarterly or yearly basis. It's what people refer to as quarterly capitalism. And that's totally understandable, and I call that Plan A. That said, in a world of change and transformation, it kind of makes sense to be thinking about future change and being ahead of the game and having perhaps a first mover advantage, and therefore positioning portfolios into the longer term, respecting the idea that conditions change and prices will change. And that's what I call Plan B, and Plan B is more difficult than Plan A. And so what we have here is a challenge for investors to kind of redo their investment approach, as I see it. It's a big change issue. And the response I see the big asset owners and the sophisticated asset owners taking up is to do with finance first and investment beliefs. Those two are the critical components to dealing with those challenges. And I just have one slide, I promise, but it does help me tell a slightly tricky story here with respect to investing wider and longer. And in many respects, when we think about the challenge, we always want to have a little bit of a map as to where we stand and where others stand in this area. And the sustainability matrix helps people get a hold of themselves and their choices. Just bear with me, I'll describe it. I'll go up the column first and talk there about investment beliefs and investment strategy. And then I'll go across the page and talk about mission and investment goals. That's fairly straightforward, and the interesting thing for me is that we can map people quite accurately on the basis of this particular tool. And if we start with investment beliefs, it is so critical to understand whether or not we believe, as I do, that ESG risks lurk in portfolios in ways that they're not fully priced or reflected, or whether or not we believe that they're actually captured by current processes. I mean, that's a very fundamental point, and one where I think we might have divergences, but the key to this is actually walking up to that particular issue and having a view about it. And many other beliefs are of that nature. So really for me, going up the page is secured by thinking deeply about why these things matter at the moment. In a world of interconnections, I think there's no question that there are more ESG type risks that do lurk and are difficult to either assess or measure. and as a result they're underrepresented in people's thinking. And so I find it quite easy to go up the page, and this is where it was Rachel who was talking about the PRI statistics, which actually demonstrate that large numbers in Australia are actually kind of on this particular level of integration of these factors. Now, organisations that have kind of made that journey are interesting. I call them out. CalPERS is a very interesting organisation for having done a massive amount of work on its beliefs to actually settle where they stand in relation to those tough questions. But as we go higher up the page, we actually have more convictions. And really what you debate there are beliefs about whether or not there's a real edge to overemphasising the ESG factors in portfolios. It's kind of a very affirmative type of investment approach that is taken at the top of the page. And there I would cite a good example in Northern Europe as PGGM, who have that type of conviction in what I call that fourth box advanced practice, that they actually believe in the sustainability beta that a number of us have written about. And that sustainability beta is based on the premise that externalities are underpriced, and at some stage they become internalized costs that weigh down future operating earnings and also affect future pricing. That belief is quite subtle and nuanced, but a number of people have that conviction. Now, I want to just sort of kind of alert you to the importance of what goes on across the page, because it provides collateral support for these ideas. And in particular, where people have not really gone beyond the traditional mission, I recognise the merits of thinking very hard about fiduciary duty. But what's captured in the sustainable business case column in the middle is really the sense that actually when you get down to it, investors want to do no harm. They want to manage reputational risk. They want to have regard to intergenerational equity. These are critical factors that they have to think about. And really to be completely traditional about fiduciary duty and just say it's just about finance, to me is not a very intelligent or proper perspective on the issue. And that's why I'm taking you wider as you go across that page.
Thank you for the opportunity of spending some time with you. This issue has been on my mind and occupying me for about 3 decades. When I first started, I had a hair like Michael here. It's now just disappeared. As you know, investing, particularly for pension funds, super funds, is about forward-looking. It's about long-term value creation. And as we've been discussing, one of the major challenges to value creation is really the sustainability challenges that the world is currently facing. And at my most bleakest moments, which were usually after going to the investment committee, and in the conversation perhaps we can talk about some of the things that you might do if you're in that position of taking ESG to the investment committee. But some of my bleakest moments were after investment committee meetings, and I took comfort in going back to some basics. And the basics are 3 leading, what I call economic indicators. The first one is the percentage of natural resources that we use that cannot be regenerated by the planet every year, and something like 50%. We use 50% more resources than the planet can regenerate. The second major leading economic indicator is the percentage of people living on less than $2.50 a day, US a day. I think the World Bank is talking about probably a bit less than 50% of people living on that. And the third one is have a look at the trend in melt at the Arctic Circle. So the extent of the ice cap and also the thickness of the ice cap. Now, some people might say they're not leading economic indicators. But to me, wealth creation for pension funds and super funds has only got one bottom line. It's wealth creation. But we can't have wealth creation if the planet can't provide us with the life support services that we need, and if we don't have cohesive societies. So at my bleakest moment, I think about why I was going to the investment committee and encouraging them to think about the risks that Roger and Michael have been talking about to long-term wealth creation, and still kept that sort of energy up. I'll look at this issue from an asset owner. I've spent most of my career as an asset owner, or recently in an advisory capacity. And my proposition to you is that responsible investment is not mainstream to the investment beliefs of most pension funds around the world. It's just not in their mind. And because of that, ESG integration is just not core business in terms of investment decision making. But I think everyone on the panel up here would say that it should be.
I'm just going to give you a brief overview of Australian Super, talk a little bit about our investments, and then I'll talk to you about our ESG integration and then our active owner strategies. So at Australian Super, we've got about 2.1 million members, so that equates to about 1 in 10 working Australians. We're at 65 billion as at 30 June, although we got the results yesterday and we're nearly 70. And we've got 190,000 different employer groups. So Australian Super formed in 2006 with a merger of 2 funds. Back then we were at 20 billion. We're now, 65, and in a couple of years we'll be at 100 billion. And up on screen, you'll see our strategic asset allocation. So you'll see that we've got about 50% allocated to equities, both domestic and international, and we've got about 30% allocated to unlisted assets. So this is where we are long-term investors. And on the right, I'm happy to put this up after I heard the discussion, but this is our investment philosophy. Our investment philosophy is a page long, so I've just given you the highlights. So we maximize members' retirement savings. We are long-term investors. We seek to add value. We're low cost. We're research-based. We have a robust investment process. We think of our investments as one portfolio. And I've just put a quote up there that says, directly from the investment philosophy, that says, we are a responsible investor. Environmental, social, and corporate governance considerations are part of our investment process. So why ESG integration matters? So as I mentioned, we are a research-based organisation, and there has been a lot of research out lately that has shown the benefits of integrating ESG. We also know a number of brokerage houses have increased their ESG integration research, and this, we find them really useful, and I've listed some on screen because they are showing the financial link. And I should say they always point out it's correlation and not causation. But as investors, we all think about correlation. And one of the other research that we are currently undertaking that's not up on screen is on, every 2 years we get True Cost, which is an environmental consultancy financial firm based in the UK to assess our total equities portfolio as at 30 June. And they will be presenting us as 3 reports in a matter of weeks, I think. One is the carbon in our portfolio. The second report is the potential stranded assets in our portfolio. And the third report is the carbon hedge in our portfolio. So looking at all the renewables we have. So we will get that report hopefully by the end of November. So just in terms of how we integrate ESG, and I should point out that for us, ESG integration means incorporating considerations of environment, social, and corporate governance issues into the mainstream investment process in order to improve investment outcomes. And we're doing this in order to create value or minimize risk. Basically how we do this is we identify the key ESG issues that can impact the value of our portfolio. I listed some of them on screen. We quantify the potential impact, and for us that means understanding the value at risk, but also our ability to influence. We research the key issues to establish facts. We develop an action plan, and for us, what this has meant so far is engagement. In terms of board and committee interactions, we have firstly, to the investment committee, we have a standard half-yearly paper that goes up to the investment committee, and it talks about what we've done and what we have planned for the next 6 months ongoing. So we go to the investment committee with topics that we think is material, but it also comes back to us. They will say to us, can you please consider various items on here? And we put that into our to our action plan. With the board, we've had recent, we do have interactions with the board. We do present them with papers. And most recently, we had a board paper go up on Monday, and they've approved for us to engage on one of these issues with ASX companies. And we plan to have a really thorough, active engagement with a section of ASX companies over the next 3 years. So being a significant investor with over 65 billion funds under management, and being a trustee, we are required to assess and manage all foreseeable risks. So we think we are an active investor. We aim to be an active investor, and for us, it means these strategies up on screen. So we do engage a lot with companies and fund managers, and our ultimate aim is to improve the long-term value and returns to our members. So one of the fundamental rights we think we have as investors is share voting. So we vote internally all at ASX 200 companies. And the process is up on screen, and this really hasn't changed much in the last 9 years. We take governance advice from AXI. We always ask our external fund managers that are active in the stock how they're voting and why, because that gives us the investment case. We then look at our own stock voting policy, which is all available on the website.
I'd like to start off with looking at the matrix that Roger showed us in the beginning of his presentation. Where do funds in Australia land? Obviously, Kelly's gone into a great amount of detail about how Australian super manages all of their responsibilities on ESG issues. But where do the majority of funds land on this? Are they at the beginning stages of this integration? Do they even fall into the camp where it's not an issue at all? What would your view be? And how does that color the way you interact with people when you're talking about ESG research, Michael? I'll start off with you.
Yeah, Rachel, I mean, that's one of the areas that interests me most is around integration. I deal with a number of asset managers, asset owners, consultants, and associations around how to integrate ESG research. And I suppose where are we at in Australia? I think it's good to use the UNPRI signatories as a proxy to investors who are keen to integrate ESG research. There's 42 asset owner signatories in Australia and New Zealand. Over 80 asset manager signatories to the UNPRI. So I speak with most of those investors, and what I tend to find is there's a spectrum of integration. When I have the conversation with those investors, we can talk at many different levels of integration. So we can talk about just straight out company integration in equities or fixed income, because the ESG solutions exist across those. We can talk about active management or passive management. MSCI puts the ESG research into indices, and on the equity side, and has worked with Barclays on the fixed income side. So these are all really good conversations that we're having on an ongoing basis. Even the way to integrate it, it's not difficult, and maybe this is one of the things that I think about when I'm having the conversation in terms of this panel and taking ESG integration to the investment committee is it is easy to integrate ESG research. It is available on platforms that are consistent with the tools that investors are using, such as Barra and FactSet, and investment committees shouldn't be concerned, I suppose, about this new style of research, because it's no longer new. MSCI is presenting knowledge on these ESG risks that has been accumulated over 20 years. However, all that said, I do find that there's a lot of talk and a lot of interest but still an inertia around actually acting on that interest and integrating the research?
I think it's mixed. With my experience is that with ESG research, going back now over about, say, 15 years with a number of different providers, what we found is that there is a sustainability signal that you can separate out from what I'd call noise and create portfolios that are quite extensive in terms of number of stocks, but have a very low risk in terms of tracking error and can finish up with sort of outperformance of between 0.5 and up to about 0.9%. So what that tells me is that the research does work if you prepare portfolios to capture it, if you want to have a low risk option. If you are looking at concentrated portfolios, there are a number, as you know, fund managers around the world who are doing that. A couple in the UK in particular who perhaps the outstanding managers who have really integrated in a full sense the ESG research. So it's available, but what I found when you go and talk to investment committees is that because they haven't thought through their investment beliefs very well, they can't take that next step into integrating ESG and looking at the products that are available in the light of their investment beliefs.
One of the interesting things about Australia when viewed from outside Australia is that it's regarded as the pin-up in the sustainability world, which is interesting. It does have a lot of asset owners that have done the PRI, but there is a riddle here, which is basically PRI does speak for gazillions of assets, but actually its influence in capital and moving capital around is really quite partial. And I think the reasons for that, I think I do want to link back to Bob's statement, which is to do with the asset owners' guidance and policy positions come from investment committees. And I think it was someone like Einstein who said nothing outside traffic holds up progress as much as committees. And there is a big piece here that we haven't necessarily got the leadership of investment committees as yet on this subject.
What's your view being in the peer group here in Australia, Kelly?
Well, I probably have to agree. I think that in Australia we are integrating ESG, and I think that ESG is on the investment committee papers. It certainly is for us, and some of the other pension funds located in Australia, we've had this discussion, and it's absolutely on their investment committee. So I'm not so sure about that view. But I also think that we are slowly moving up the matrix that was shown earlier. You know, we all probably had to start on 1 before we moved to 2, 3, 4, and 5, and we are on that journey.
Yeah, and along those lines, I agree. I think that there are investors out there like Australian Super who are on the leading edge, if you like, on the frontier of integrating ESG research. And the same with a number of asset managers that we work with as well. And I think that's an opportunity for these investors and for these owners, an opportunity that doesn't exist for those investors who aren't yet aware.
Yeah.
One of the positive things we have in Australia is that we are really collaborative. I mean, we have organisations like ACSI, IDCC, where we all get together and we all talk about these issues. So as an industry, we are moving forward, and I think that's one of the things that's quite different here, is where we will all get together and we will talk about these issues.
Changing tack slightly, it'd be remiss if I didn't pose to the panel the questions that Bob brought up in his presentation, those 3 key questions of do investment committees demand integration? Do investment committees understand the products on offer, which I assume is a question about the depth of understanding of the fund managers? And do asset consultants encourage? So I'll give you an opportunity. Would you like to answer your own questions first, Bob?
No, and no. Look, to be fair, what I found with investment committees is that everyone has a world view, and they'll approach every opportunity from that perspective. And if that world view doesn't include an understanding of the services that the planet provides us for our life and cohesive societies and so on, then they'll find it really difficult to sort of connect a discussion about ESG with investment returns. So to me, it's a question of how do you encourage investment committees to really debate that key issue of investment beliefs at the start and really nut that out. Because if you can get that off and running, then an investment committee will then make a decision about whether it sees sustainability as a material issue that it needs to address in the way in which it invests. If it does, it can then take that through into mandates. If it doesn't, it has to be honest and ring up UNPRI and extract its name from its signatory. And on the second one about products, well, again, if the investment committee is interested, then it has an opportunity to look at the various products. But that then relies upon the asset consultant that they have chosen and their view. And what I found with asset consultants, and they're not all the same, Roger, right around the world, but with asset consultants, you know, what I came to understand was to try to understand their business models. I mean, where they get their revenue from, what the business risks are in recommending a first-time manager, what their worldview is about sustainability. And so you might well find that your asset consultant is never going to help you, even though they'll be very articulate and fudge that, they won't be able to help you, and you'll need to actually change asset consultants. So I think that every single player in this investment chain and the value chain has a role to play in helping investment committees really sort out where they should go. Fund managers, I think, will follow where the money is, so that if the asset consultants and the asset owners want to pursue a certain direction, if that is going to be sustainability-driven investments, fund managers will follow that.
It's difficult to deal with the subject without generalising too much, as it were, but I think consultants are a bit of a soft target here to some extent. You'd expect me to say that. Back to another Einstein quote, which is make everything as simple as possible, but no simpler. I do think that time is our villain here, really. That what I find very difficult with this subject is that it's not invited in to the discussion. And so I think consultants they're not discouraging to this subject across the world as I see it, but they are a bit agnostic to it, and they're not showing leadership, and I think those qualities are needed. I think they're needed big time, so I couldn't agree more with Bob that this worldview thing actually needs to be expressed. Investment committees can do a certain amount of work in their regular business on this, but it never really gets anywhere. My experience is that it's discussed, but there isn't the action. And so I've kind of changed my tune. That I'm a big believer that really, if you're going to come at this thing, you need to commit a project. Change management is not something, again, that happens overnight. It is a change of a way of operating. And so investment committees actually have to, and asset owners have to commit to transformational change. It's a technical phrase, it sounds like jargon, and in many respects it is, but it represents the realistic proposition that this change is big and actually demands a lot of time and attention.
In the answer to those three questions, the board and our investment committee is aware of ESG. I've talked about our investment beliefs up there. They've asked us to look at certain topics that we didn't even come up with, so they are really on board. In terms of fund managers and products, the way we do it, and I know it's different from other funds, is we have a 3-person internal fund internal team, and all their responsibility is to look at our external fund managers. And to get on the list, you have to be rated by Mercer. So the long list comes from Mercer Jim D. They will look at the long list, and then the RFPs are sent out. So if you're not rated by Mercer, you won't get through. So there's not a lot of asset consultant interaction in that process, although they do give us their opinions on the final ones. With our asset consultants, it very much depends on what we ask them. We use 2. One is more, one gives us more research and opinions than the other. So it depends on your asset consultant, and I agree with Roger, it's up to them.
Will this process change at all, or can you foresee the process changing as Australian Super continues this process of internalisation?
Yeah.
And do you have, and are there any, I mean, obviously you've only done phase one of the process. But
so we have those 14 RFP questions, and those questions are broken up really into 5 main areas, and that's how do you integrate ESG? Tell us about your proxy voting. Tell us how many times you have voted against management, because that's always a key. We have some fund managers, they just vote for them all. We also ask about their engagement. Tell us about some of the topics you've engaged with your investee companies on. What in-house research, ESG in-house research you buy, subscribe to, or pay for. And which investor groups are you a member of? And if you are a member of the UNPRI, we ask to see your most recent report, because that gives us a comparison. And thankfully for our internal team, I answered these questions on their behalf, so I can say we do really well.
Okay. As a service provider, do you have a view on these 3 questions?
Yeah, definitely. I was thinking about like how we contribute to that, and I think overall it's through providing research for the investment committee. To be able to make these decisions, providing research that they can have confidence in because of our ability and expertise in this area. We do analysis on these global themes. We write reports on that, as well as country reports, as well as industry reports. Where we don't have existing research, we can go that extra step to help these committees get the evidence they need. And whether that's something complex like a materiality assessment of an industry or a key issue, or whether it's something simple such as what's the impact of removing tobacco stocks? What are the options to removing tobacco stocks? And there are options to these things. You can use GICS categories, which investors are comfortable with, or you can use a screening tool, which I suppose is more complete in its assessment of a company's exposure to these activities. And so, being part of MSCI under our new One MSCI umbrella, we've got the tools to share the ESG research through different platforms, through the indices to be able to calculate performance exclusions, through ISS, which does the proxy voting, as well as the governance data, so raw governance data that can be used aggregated up to the investment committee reports.
In terms of outcomes, Bob, is that process of measuring outcomes important for spreading this out of the ESG integration as something that should be part of the belief standard? Are the signals out there to do that?
Yeah, I think it's the most difficult area as well, because sustainability is really a long-term issue in terms of outcomes. But it is important to have a conversation about, what are the major determinants of shareholder value. So you can say, perhaps 2, increasing free cash flow to the firm, and secondly, reducing the average weighted cost of capital. And so, how does sustainability impact margin improvement? How does it impact revenue growth? How does it impact costs? How does it impact reinvestment rates when you reinvest in the firm? And how does it impact your risk of capital, the average weighted cost of capital? So I think one has to be able to do that conversion from here's sustainability and here's how it's going to translate into shareholder value. Now, difficult process, but one has to go down that process. Otherwise, you're not actually achieving what you're setting out to do, which is increasing shareholder value at the end. Difficult, but must be done.
And does the research lead us any way forward on that, Michael? Is there does the improving or the spread and the depth of the research available help contribute to benchmarking the outcomes for ESG efficiency or added value?
Yeah, I think and that's a good point. The idea of benchmarking and how that is seen to add more value. The depth of research that we're doing is improving all the time. We've got 100 research staff now who focus full time on analysing these risks. as well as comparing the risks at a company level, we compare them. There's a relative rating across companies globally. So you know, this information now allows you to look at Woolworths not just in the context of Woolworths and Coles, but Woolworths and Coles versus Sainsbury, which is the global best practice for managing their ESG exposures under the key issues that we've identified. So you know, I think all of this information, the depth of research and the changing focus of the research, like we were talking before about the more macro issues. I mean, we've just released reports on water stress, you know, on climate change, corruption, instability, all of these at a very high level to help make these decisions easier.
In one sense, I think we have the technology parts of the process. You know, we have the measures. It's actually the human parts that seem sort of not quite in place. It's the leadership, it's the courage, it's the culture. You know, those pieces are a bit weaker, but actually, in technology, we actually can do this thing.
And I think those pressures are coming. And just something that Bob said earlier, we are getting more and more communications from our community, and that is from our members and from NGOs. They are now writing directly to our CEO, and their ranges on everything from board directors to carbon to human rights. So that forces that member communication and that NGO engagement is raising the issue as well, and so we are also dealing with it. So it's coming in from all angles, and I think it is just a matter of time, but it is coming. And we think, you know, we respond to our members and we respond to the various NGOs all the time.
Are there any questions from the audience at this time, or any comments?
If I may ask a more broader question, shifting from Mercer, it's interesting to hear the panel talking about fiduciary duty. So also, you know, probably most of us are aware of what's happening in this part of the world is more internalizing the investment process. So my question really related to you know, fiduciary capitalism. What's the panel see the role of changing, you know, all the agents like asset consultants, managers, also, you know, service providers, we're all on the same boat, I guess. But before you answer that, I'd just like to make a quick announcement of you know, as a consultant, you know, we actually really think ESG issues are very important, and we've been working in this space for more than a decade. So, you know, I'm happy to share with you guys after the talk about, you know, what we're doing in this space. And my colleague Richard also here, so you're happy to answer any questions you have.
Sure. Fiduciary capitalism.
I love the phrase, actually. It's going viral, that phrase. So it does represent the idea that those that manage the assets of others are in a very important position as fiduciaries, as in they owe a sole duty of care. It's a very direct relationship, and that duty is very, very sovereign, very, very precious. By the way, there's a factoid here which I kind of carry around, which is that basically for every one person working at an asset owner, and there are a lot of asset owners in the Australian community amongst the super funds, there are 20 people working in asset management. So the value chain is pretty pretty strange. I mean, I think it was referred to, it was the asset manager kind of is the tail, but it's wagging the dog. It's very much a kind of value chain that hasn't evolved. Now, one of the reasons for that is that we are in the asset owner community in our first generation. You know, if you think about super funds, really, it's one generation old. So we shouldn't despair that we haven't quite got the value chain right. I think we haven't got the value chain right. I think we really should be working harder within the asset owners than we have done, and I think asset managers have to be, you know, more prepared to work to new mandates. These mandates that they've had in the past have not been necessarily set up to do their best work. So I think there's a lot wrong with the value chain, and I like the question. I think we'll see, you know, many attempts to kind of evolve that value chain. By the way, in many respects, Kelly talking about internalising at AusSuper, that's a worldwide trend. So the big asset owners are internalising activities where they can. And this is changing that balance between the 1-for-20 ratio that I spoke of.
Mm-hmm. We want to reduce that, so we want to have direct relationships with the company that we're invested in rather than what it was before. But we will still be keeping our external managers. You know, as we said earlier, we have a team who have already invested, and we will be doing other asset classes. But we are now becoming more direct, and that's what fiduciary capitalism means for us.
I'd add another word in between fiduciary and capitalism and put sustainable capitalism. So fiduciary sustainable capitalism. And I think that if we could get that imbued into asset owners, it would be fantastic. Look, asset owners have the power. You know, to me, it's where capital goes is going to really be the answer. And so asset owners, I think, are on the journey but haven't yet stood up to the plate and really established in their own mind the power they've got actually to start dictating to asset consultants and the fund managers what they really want. But I think it's coming. I think it's coming.
From my perspective, I mean, the tools are there to measure these risks. You know, and the quality of the reports that we're providing our asset owner clients is giving them information that they can have confidence in and measure these exposures, which will assist with their allocation of their assets.
Are there other questions from the audience? All right. Well then, yeah, please.
Question relating to materiality. So many of the panel members identified that there are numerous ESG risks or issues that could be measured out there. What is the process for determining what's material, and in particular, how should investors engage with external stakeholders to help determine what is material?
Okay. So question on materiality and how you determine materiality. And who wants to take a stab at that one first? You were talking about members, the students, in terms of stakeholders, talking with members, talking with NGOs. Do they play into the materiality assessment?
Well, we quite like engaging with NGOs because they're on the ground. Firstly, they know. You know, I'm in level 33, Lonsdale Street, far off the ground, where a lot of these NGOs are, you know, really in these emerging market countries. And I'll talk. So we've been engaging with one particular NGO on child labour, forced labour, and risk through the labour supply chain. And they're on the ground, and they tell us what company XYZ that is listed on the ASX market is doing. So we form those relationships, and we can go back to company XYZ and say, look, you know, this NGO said this. Please tell us what you're doing about it. You know, so we really do engage with NGOs. I'm sorry, the question was on our process or materiality. Was
yeah, the process of external stakeholder engagement is how to identify what's material.
So NGOs are a great source, and we have an open door with them if they want to talk to us. So we've had NGOs come to talk to us about, well, child labour, the Bangladeshi fires, for example, those companies that were involved then, and also on climate change. They're very active on that one. So they absolutely form part of our thinking and determination, if that helps you.
Is there a materiality assessment from your perspective?
I mean, just quickly on materiality, you know, you've got materiality in terms of financial impact, materiality in terms of impact on reputation. You know, both of these things need to be addressed. You know, we take quite a standardised approach to it, based on, you know, from a financial dimension, based on the history of certain issues and their impact on a company's operations. In terms of reputational risk, we look at things like the Global Compact, and we measure companies' behaviour against a set of 30 indicators, and for each case, in other words, for each event that occurs for a company, we determine the severity and the type, and companies that are particularly bad get red flagged. There aren't a lot of them in the world. Out of the coverage of over 5,500 companies, we have at least, I think, around 50 companies that are red flagged, so it's very severe and structural. They pose what investors see as a massive reputational risk, which could be considered material.
And just in terms, we also engage based on the MSCI red flags for our international equity managers. But using that same research, we have also started to incorporate that into our fixed income. So we are now, part of our strategy is direct, we'll be bringing it in-house. There was an opportunity that came to us. A particular company was seeking funding, not from the banks, but through superannuation funds. We had a look at this company, seemed fine. We had a look at the MSCI ESG rating, and it was just poor on governance. It was, and our fixed income team, our internal team, based on that report, said we're not going to lend any money because it was just, and we focus on governance because fixed income is 3 years, short term, and so that was an issue. So for us, we'll be looking more at fixed income in the first 6 months of next year.
I'll just add one thing. I think there's materiality in terms of the impact on the financial returns of the investment, of course, and the long-term shareholder value, but there's also materiality in terms of the broader world issues. So if, for example, you're investing in farmlands, the approach to managing those farmlands by the investor could have a significant impact on downstream users, for example, if you're in a broad catchment. And of course, if those externalities are not priced at the moment, then you might say, well, it's not material to my actual performance, but it is material in terms of sustainability in a broader sense. So again, if you're a universal investor, then you should be concerned about that.
Yeah.
And I think often we just tend to focus on the impact on the firm itself and not that wider impact, which will eventually come back to bite you.
Continuing with the discussion with the investment committee, and so Roger started off with saying that it was difficult, interesting and rewarding, and we've had some good discussion about the difficult part of it, especially with asset owners being measured on annual performance. That makes things really tough. I was wondering what Roger and the rest of the panel thought the main elements of the reward proposition were. If you just speak a bit about that.
Kelly has said it all along, it's about investment outcomes. I don't think there's any doubt that dealing with these difficult challenges in the investment landscape that Bob has spoken to very eloquently will be difficult if we don't make some changes, and the outcomes will be worse if we don't make some changes. And again, you have to understand the chain to kind of get that feeling. So the chain at the moment, if you actually think about savings through investment, asset owner, asset manager, into corporations and then on to consumers and society, that chain is very clunky and difficult and not really working tremendously well in our capitalist system, my view, my worldview. But I think there's no doubt that this approach to investing is set up to create more wealth and to create more wealth for the asset owners. And actually, as a result of this, actually, it's very much the other element of reward is it's good for society. Rarely do I come across things that are truly win-win, but actually this is truly win-win, and that's an extraordinary possibility.
Could I comment on the reward? A couple of experiences that I've had is that you start with a member of the investment committee who was shaking when we started to talk about sustainability and ESG, because he felt that it was not really part and parcel of the investment process. And to see 4 years later that person sort of get it and then start to articulate it and support it and engage with other directors. The other rewarding one was where I think we were the first at Big Super to introduce true cost here in Australia, and one of our directors then took that concept to another fund, and you think to yourself, that's really, to me, a great outcome in terms of getting the issues of sustainability and the various providers extended throughout the value chain. So I think the reward for me was seeing the change that took place with debate at the investment committee, even though some days it was very tough.
Yeah, I've got the same story. It's a very similar story. We did a report, a portfolio level report for an asset manager more than 12 months ago. It was about 14 months ago. And you know, the idea being that they get this report, it shows them an overall portfolio level score, it shows how that compares to the standard benchmark and to an ESG optimised benchmark. And then it breaks it down into different areas, sectors, key issues, and so on. They got the report because they wanted it for UNPRI reporting, and they also wanted to show it to their clients. This is our ESG, profile of our portfolio. When they got the report, they were extremely disappointed. Not because of the quality of the report, but because their score was so poor relative to the benchmark. And I thought, oh, yeah, it's a shame. And didn't really hear from them for another 12 months. But then they rang and asked for the report again. They want to see. And I thought, oh my gosh, they've listened. They want to see how it's compared and talk about the change. And well, let's see what they've done to their portfolio, because their performance was pretty good. They haven't assessed their ESG any other way. We ran the portfolio as it stood at that time through the system, came out. The overall score had improved dramatically. And they were really pleased. They'd gone through, made some changes, obviously included some of the information in their investment process. They had a good result.
And Kelly, what's rewarding for you?
Well, I guess the reward I've seen personally over my 9 years is just the progress that we've made in this area. You know, as I said, 9 years ago, all we did was voting. No companies would talk to us. They didn't even know who we are. Now companies are calling us. We can talk about issues like diversity, succession planning, strategy to them. Also, I've seen the progress in terms of our fund managers. They are now being involved. So they are now talking to us about, you know, labour supply chain risk. They're talking to us about bribery and corruption in certain companies. So I've seen that grow as well. And I've also seen the growth in terms of our member engagement. So we have over 2 million members. We might get maybe a handful of letters, but you know what? Those handful of letters are great. So we've seen it, and we're seeing a lot of that increase as well. And I just think all these three will just increase.
Thank you. Seems like a good note to end on. So I'd like to thank Michael Salvatico, MSCI, Bob Walsh from Sustainability Advisors, Roger Irwin, Towers Watson, Kelly Christodoulou, Australian Super.
Thank you.
Thank you.